Alright guys, welcome back. This is episode 2 and today we're going to be talking about the basics instead of trading. Alright, let's get right into it. So what is leverage? Leverage in trading is when you borrow money from your broker to increase the size of your trades. This essentially allows you to potentially make larger profits, but it also comes with a higher risk of losing more money. So that's what it is. It basically allows us to borrow money from the broker that we use to open up larger trades to make larger sums of money, because not all of us have $50,000 or $25,000 to start with, so we have to use leverage to compensate. I've wrote some text right here for you guys so you guys can have a better understanding of what leverage is. Pause right now if you're not sure or if it doesn't make sense and read for the text, because I'm going to move on to the next point. Alright, so what is a broker? A broker is pretty much like the middleman. We sign up with a broker and we deposit money inside of the broker so we can trade stocks. We can buy and sell stocks for the broker, and every broker is different. Some brokers offer commission, some don't. Some brokers have better spread than others. I'll talk about what spread is in a later episode. And there's a lot of distinctions between brokers. There's good ones and there's bad ones. And when you're beginning, you should always do your research when you want to open up a broker account. But yeah, yet again, if you do want to pause this and read this, pause now, because I'll be moving on to the next point. Oh yeah, and I do want to mention every broker has different amounts of leverage, and some brokers let you trade on different types of platforms. What I mean by that is some brokers only let you execute trades on certain platforms. The platforms which I'll be teaching on is going to be TradingView. Majority of traders use TradingView, and I personally think it's the cleanest and the nicest and the most simple platform for trading. However, some brokers won't or don't allow you to trade in TradingView. So what are trends in the market? When the market is trending up, this is what it consists of. It creates higher highs and higher lows, then a higher high and a higher low, and then a higher high. This is an uptrend right here. Now, this orange thing right here, this is called a consolidation, or as some people might refer to it, accumulation. Price doesn't really do anything around here. As a matter of fact, 70% of the time, price is actually doing this right here. Accumulating or consolidating, however you want to call it. So yeah, how do we know if price is an uptrend or consolidating? Usually in a consolidation, it's going back and forward, taking highs and lows, refusing to go up or down. It's stuck in a place and it's not trying to leave. And yet again, I'm going to repeat myself, 70% of the time, the market is stuck in a consolidation. Now, the downtrend is completely opposite of an uptrend. When it's going lower, it's making lower lows, lower highs, lower lows, lower highs, and then a lower low. The way the market shifts paradigm, or the way the market changes, the way it's trending, is by breaking a higher low. So, as we can see here, it's creating a higher high, higher low, higher high, and then since it creates a lower low than this low, then the market has changed structure and is now trending downwards. If this low here is broken, then that means we've changed trend and we're gonna go lower. Same with this high right here. If we were to go lower right here, let's say, and we were to break the high, this high right here, that means we're bullish, or it also means that we're going to be going up we're going to be bullish. We're going to be going in an uptrend. I'll be talking about more about market structure shifts and trends in the market and how to anticipate them and how to not get stuck in a consolidation, because getting stuck in a consolidation can, well, it will always pretty much lead to you losing your money and your time, because the market will tend to sit here in this range consolidation for a while. So now, premium and discount. There's many ways of distinguishing what is a premium price and what is a discount price. But because you guys are beginning and I'm going over the basics, this is what I'm going to show right now. Later in the mentorship, I'm going to show many more types of premium and discount levels. But I believe this is the basic one. When we have a big range like this, and we measure the high to the absolute low, in that range, anything above 50% is premium. And in that range, anything below 50% is discount. Same here. We can see the market coming lower and then coming higher and coming down a little bit. If we measure this high and this low, anything below here is a buying opportunity and anything above here is a selling opportunity. You never want to buy in premium and you never want to sell in discount. This leads to so many mistakes. And if you just follow this simple rule, you will avoid many mistakes and you will avoid losing lots of money. Yet again, I'm going to repeat myself. I'm only teaching the basic beginner premium and discount levels. Later in the mentorship, I will teach more because there's all kinds of ones. Alright guys, I think this concludes this lecture. In the next lecture, I'm going to be talking about risk to reward, calculating lot size, risk management, and probabilities. Thank you guys. See you in the next lecture.